All right, all right, all right. Good morning, everybody. Good morning to you, John Walkup.
Hey, Noah, good morning to you, and good morning, everybody. Thank you for joining us on this. Honestly, it's a lovely Monday morning. I know
It's beautiful
weather
out there.
this weekend was just perfect.
This is what I'm talking about. This is the weather. This is the time. Got a high pressure system coming over here, John. That means good weather for another week and a half. You see, I don't know if you guys know I have some meteorological.
You need a green screen. Show us the fronts.
We got some good weather here. That's good. You know what? Good weather, happy weather. People in a good mood. They're out. They're doing their thing. You know what? People make good decisions.
Well, speaking of out, I mean, I don't know how many people participated, but at least in Manhattan, they had the summer streets. So they had, you could bike, hike, walk, whatever you want to do from the Brooklyn Bridge all the way up to Dyckman Street up in Inwood. I did the whole thing. I did like a huge loop.
Look at you.
It was a ton of fun.
That's awesome.
It was just me and 20,000 of my best friends in the city, just saying hi, hanging out.
We should do some kind of UrbanDigs community gathering in fall when the weather's real nice and get everyone together and see if we can rent out a place and just hang out, have a couple drinks.
Thanks on Noah.
Talk about the markets. I'll do it. If you guys want to do it, I'll do it. If you guys do it, just put something in the comments. That's all I got to see. A bunch of comments that you want free cocktails and talk about the markets, and we will.
No, we got to do it the other way, the way that TikTok people do it, which is like if we get to 10,000 likes, we're gonna have an open bar. Or something.
I don't even know if we know 10,000 people.
I don't either, but that's what they say. So it works, apparently.
Guys, we're just messing around here before we start, but we're going to get going over there. That is John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs, and it is Monday. So you guys are going to get a little macro Monday coming right at you. For those of you that are new to this show, we're going to start out with Manhattan real estate, go over the weekly trends, go over the monthly trends, and then we're going to go to a bunch of macro topics. I got all these tabs up here that you can't see. Hopefully you guys have some thoughts on the topics we talk about, and then we'll circle back and we'll end with Manhattan real estate. We will try to do all of this in 30 minutes or less. Sometimes we succeed, sometimes we don't. But we always try to be cognizant of your time. We do talk about tradable markets in this session. So please, guys, financial advice, do not start day trading anything that we're talking about here. It's not financial advice. Okay?
Just because they're tradable doesn't mean they should be traded.
That's right. I want to start over here with the ticker, guys. I'm on 1 month Manhattan ticker. We're focusing right over here. 30 days, 1,040 new listings came on the market. John, that is supposed to be 943 by the end of August. There's a bunch of big numbers right over here. This is a 30-day look, right? So you got July 5th over in the back end of the pipe, and you got yesterday in the front end of the pipe. This is the front end. This is the back end. And when I look at the back end of the pipe, this stuff is fading out, right? Tomorrow, that'll be out. The next day, that'll be out. The next day, that'll be out. So there's some big numbers here. So once we get past another week or so, this number is going to probably drop notably.
Yeah, that number is probably going to start going down simply because listing before Labor Day is sometimes not necessarily your best bet because you don't want to be on the market 2-3 weeks and then it's Labor Day. You kind of want to be on either right around or just after. So usually one of the quietest times of the year in terms of listing activity, and we're about to enter it.
Correct. So 943 is our benchmark. The fact that we're at 1,040 now, I think, is just 30-day dynamics. In about 6 or 7 days, that'll probably go lower. So we'll keep an eye on that. When I look at contract activity, I see 821 contracts signed in the last 30 days, down 18%. That is supposed to be at 854 for the month of August. And just like supply, this is big numbers right here. And that's going to fade out over the next 7 days. So this is probably going to drop. I don't know, man. I don't know if we're going to get to 854 by the end of August. I feel like we're going to have.
Well, that's the thing. So August is quiet and September's even quieter. So it's not like you can say, well, Labor Day, we're going to get some buyers back. I mean, maybe a couple will come back, but September is typically still quiet on the contract side. So we've got an extended period of quietness ahead of us. So to me, it's always tricky when you start adding supply and then you still have to wait for the buyers. Given everything that's going on, I always find that a little bit of a precarious situation for the market to find itself in.
Yeah, and this is what it looks like, what John's talking about. Let me get all this previous writings out here, right? We are where? We are here, somewhere around there. September is actually our weakest month. A lot of people just scratched their heads with that. And that's just about logistics, really. It's just about the fact that September is when all the listings come on, and it's really October when all those deals get signed. But the activity is there. The non-measurable activity, the bids, the open house, the traffic, the accepted offers, that's all happening in September. It just doesn't get signed until October. So the action really does start right around mid-September. So we got about 5 weeks or so.
Talk amongst yourselves.
Talk amongst yourselves. Assuming that there is, I see a couple of I'm ins who would love to get, guys, free drinks. Who's not in for free drinks? Just put I'm in the comments right here, and we'll do free drinks. I'm talking about the whole rentable.
It's just off of 72nd in Central Park. It's a water fountain. There's a fountain for the dogs. It's great, but it's free, totally free.
Free. Credit spreads, guys. I want to pivot to the macro portion of the program. And to do that, we're going to go to credit spreads, guys. We're looking at the spread between corporate bond yields and the 10-year treasury yields. That's what we're looking at. There's a spread there, and that spread is narrowing or widening. When it's narrowing, okay, that means this thing is going down, and that's a good sign. That's a risk-on sign. When it's widening, that means this little index here that I'm showing you on the screen is going up, and that's a bad thing, but we got to monitor it because I want to show you guys what's going on here. Look over the last couple of days, okay? We basically reversed like 1 month of narrowing has been wiped out in the last couple of days. It looks scary. And we also ticked higher on this little credit stress indicator from 1.6 to 2.1. But, John, hold the thought. I just want to let you guys know. I told you guys that we are on the threshold of these two levels. So we're like somewhere in between these two levels. So the fact that you're going back and forth in these two levels, don't look too much into that. We need to get to either one more level higher or one more level lower for a real signal. Because look, 1 month, look at this. Looks scary, right? Scary. But when I go to 6 months, and look out, look at what it looks like. Okay. So like zoomed out, not a big deal. Zoomed in, keep your eyes on credit because it's widening right now.
I mean, who could have called it?
You did. But yes.
I did. That I called.
This guy.
I still think I'm looking at this. I still think my bias is a little bit to the upside. We're starting to get some data creeping in about prices, about jobs. And it's just that underlying theory about how the economy is looking is perhaps not as rosy as it was in May or in June. And it's just starting to reset some expectations. And that, to me, is going to push credit spreads a little bit higher. I don't necessarily think we're going to see a repeat of what we saw when the Liberation Day rolled around. However, I do think, it's a lagging thing, right? You change something and you got to wait for these effects. It's even slower than the real estate market. So we just have to wait for that data to come in, and it's only now starting to trickle in. And again, it's only now they're still being decided. So it's going to be an extended process to get that data in, and it just adds uncertainty. And to me, like, I can see them drifting down once things settle down. But again, it's just that bias to the upside is going to be just knee-jerk reaction up.
Okay, well, let's see, guys. This is when we keep our eyes on it. I don't know if the stock market's starting to fall. I haven't checked it this morning. But typically, as these credit spreads start to go up in a meaningful way, that's when you're going to get risk off. Risk off means the stock market goes down, just like where's that 1 year? Just like in April. Okay, and you can see where we are relative to that. Didn't start yet. Early stages. Watch this. You watch this and you look at the stock market and you'll ultimately see the correlation both ways. When this goes up, stock market down. When this goes down, stock market up.
Yeah.
Okay, risk
well,
off.
Market's up a little bit. But again, I mean, it was at record highs last week at the beginning, or maybe a week before. And it's settled down quite a bit since then. So, I can understand there's a little bit of a reset going on. But I mean, you think about the lows that this market saw in April. I'm talking about the S&P, to the highs that it saw in August. I mean, that is an amazing run, right? It was like 4,900 up to 6,400. I mean, that's fast, it's furious, and we're still sitting at high. So, it depends on how you look at it. And again, I think one of the things you like to say, Noah, is that, rallies just thrive on, uncertainty and uncomfortableness, right? Isn't that your phrase? Something like that?
Well, I know that rallies, I mean, it usually takes the staircase up and the elevator down. Usually is what happens. But I mean, listen, I mean, the dollar's also down. The dollar's down a lot. And, the stocks they could be going up because the dollar's going down. So there's so many things at play over here. I'm just going to keep an eye on credit spreads and see if this develops into anything. I'm going to call it right now. I don't see anything crazy here right now. Let's give it another couple of trading sessions and see whether or not this whole thing continues higher or it corrects back down and it's a big nothing burger. So eyes open. That's all this is telling me.
I don't think it's a nothing burger, but we'll see. We'll see.
All right. Guys, if we're going to have some crazy, let me go look at the max. If we're going to have some crazy recession and the stock market's going to fall 50%, this indicator is going to go skyrocketing higher. And this index is going to go way to the right. Okay. So we're going to keep an eye on that if it happens, because now we got tools that's going to track it and tell us and measure it. Okay. So if that's going to happen, we'll see it. Till then, we'll watch it. Pivot to rates, guys. Rates. Any questions, Johnny, by the way?
No, all good. Oh, actually, Scott asked, what percentages are we seeing private exclusive? Sorry, let me just read this as I see it. What percentages are seeing as private exclusives, therefore possibly messing up the numbers? Oh, I think Scott's going back to the market data. That's a great question, Scott.
Good question, Scott.
I could answer that.
I don't know the percentage offhand. I know it's a growing thing. Is it 2 weeks? Is it like off private for 2 weeks, and that's their window, and then they gotta make a decision or something like that? I think is what it is. I don't know the answer to it, but if it is, it's probably under 10%. I would think. I don't think it's a big number.
I don't know. I have my own thoughts on private listings too, but
do you want to share those?
No one wants. I don't. I'll state. I have other soapboxes I'd rather climb up today when we're talking about macro stuff.
Okay. All right.
My quad workout on the other soapboxes.
Oh, okay. Scott, we'll see if we could do a little investigative research on that and try to get some solid data before we report on it or anything, just for the namesake of accuracy and confidence and all that kind of stuff. But very good question. I want to pivot to rates, guys. We are on the Fed Watch tool. You could do this yourself. I am on the probabilities table. I refreshed this just before Macro Monday started. So like 15 minutes ago. This changed, guys. This was the jobs number, John. Bad jobs number. Well, weaker than expected jobs number. And the result of that weaker economic data was more Fed cuts expectations. That's the result. So let's just read the tape. Guys, let's read the tape. We are here. All right, that's where we are right now, 425 to 450. The next meeting date is September 17th. This is a big change, John. 86% chance that we're now going to have that quarter point cut at the September meeting. I don't know if the Fed's going to mess with that one. So I think it's coming.
I mean, yeah, it's still a ways away, but it looks like it's coming. But it looks like it's coming again. But I mean, look, the market is so focused on jobs because that's at least a number that they can measure, and it seems like it's moving from month to month. Whereas the inflation numbers, I mean, they're starting to come in and they're starting to look like, oh, there actually might be some inflation in the pipeline. So look, it's 88%. I don't want to necessarily go against that. I don't think I'd certainly put money against on the 12%. But what can I say? I still think there's a little room for argument there.
Yeah. Well, that's what the tape has right now, and that's what the markets are expecting. So that's all we're going to report on, guys. When it comes to rates, let's just report on what the markets are expecting. Here's how you say it. If you find yourself in a conversation with someone, when I look at the Fed fund futures and I look at the next meeting date, there's an 86% chance they're going to cut 1/4 point. That's a quarter. Each one of these boxes is 1/4 point, guys. Okay. 1/4 point on September 17th, 86% chance. That's it. That's how you report on it. You're just looking at these numbers. It's the easiest thing in the world. You can't mess it up, right? Then in October, they got another cut. Okay, that other cut's a little 62%, 33% pause, 62% 1/4 point cut. So there's 2 cuts that are now priced in. That's a phrase you guys could use. And then again on December, and again, we're starting to get a little lower now, 51% chance of a third cut, 1/4 point cut. Now, guys, we don't know if this is going to happen. I know John and I are on record for saying we think we're going to get 1, maybe 2 cuts, right? We could be wrong. Things could change. And this jobs report did change things. That's the thing. Data comes out, changes things. And right now, the markets, rates down because the rates are down because the markets are expecting more cuts. So it's priced in already.
Well, I think the difference between the rate cuts of last year and the rate cuts this year is, I think we're finally, a year or so ago, we were looking at rate cuts to almost just sort of bring us back down to normal. These rate cuts are sort of like stimulate the economy base, right? They came out after a bad number, and that's the market trying to say, all right, well, maybe the Fed's going to have to step in. That's not a great case for mortgage rates. When you have to stimulate the economy, maybe you get a little bit of relief in mortgage rates, but generally speaking, you're going to have a hard time because credit spreads can go up because the economy's not doing well, and then people just might not be buying. And one of the things we talked about on our Friday report, I think we talked about it here, is there's a huge difference between the luxury sector and the non-luxury sector. And, again, most of the volume in this market is usually in the non-luxury sector. That's the financing contingent one, and again, it's just under pressure. And these things just reiterate to me that there's just a continuance of pressure in the pipeline for that sector.
Yeah, I feel like the mortgage rates are going to make their move in anticipation of whatever Fed's going to do. And you're right, John. If the Fed starts cutting because of its weaker numbers, you're going to get a little bit of lower mortgage rates, but that's going to happen before the cut even happens, like over the course of the whole thing getting close there. And you're right. I don't know if it's going to have a stimulatory effect on buyers. I just don't know. So we're going to have to keep that coming. I see a comment right over here. Scott again. We love Scott.
But yeah.
I don't think the cut is coming because the Fed Reserve is trying to stabilize the economy. I mean, I don't know. I mean, right now we got 86% chance. As you get closer to September 17th, this number is going to solidify itself. If that's at 85 or higher come Fed day, and the Fed doesn't cut rates for whatever reason, the markets are going to probably react negatively.
Well, I think you had the jobs number Friday, then you had the revisions for the prior months, and they went from like 200,000, and then they just sort of almost erased. So you can see the last bar on the right is the most recent, and then the two before it were almost at that yellow line, and they were revised sharply lower. So the other thing is, if you look behind the numbers, most of these increases are coming from the healthcare sector. So it's the private sector on its own. I think we're going to be talking about this later. The private sector on its own not doing too great, and that's again. These are the buyers of the non-luxury properties. So 4 million above, yeah, they're having fun. But under than that, it's a tough market out there.
Yeah, and here's that chart that Johnny was just referencing, guys. We had most of the job growth in government, before this new administration, and that's this orange right here. And you're right, John, that the private sector has just been, down and out. It's almost like sales activity for the real estate market over the last 3-4 years. It's down and then just staying down, kind of a thing. That's private payrolls down there. Yeah. So
and we're getting the other things. We're getting to that point in the calendar year when retailers they've already probably placed their orders for the holiday, and they're trying to get a sense of how tariffs are going to affect things and what that means for hiring. So it could start getting a little bumpy here as we approach the end of the year.
I think the takeaway, guys, what you need to know is that the macroeconomic data. This is Macro Monday. The macroeconomic data that came out mainly and basically. I said basically. Basically, the new word. Basically, the jobs report came in much weaker than expected. That is causing this, and that's causing the expectation for more cuts. Okay, and that is what's causing this, guys. The rates to go down a little bit. Not so much in jumbos, but you can see the conforming rate. Look at the blue, the dark blue line. That's the conforming. The jumbo's a light blue over there. That's been coming down a little bit. I got 30-year jumbos at 6.874. I left up my range from last week. I'm going to keep that up there so we can come back and check this. It looks like the conforming is breaking that range a little bit. So typically when that happens, the reason you have support, guys, is that when you break support, it goes down to a new tradable range, right? So now the range is in this level down here. And that's how these things work. That's why you have support on the upside and the downside to track. So will this blue line follow suit and come down? So far, it hasn't. I mean, so far we're at 6.8. It's negligible. Down, but negligible. Okay. Questions?
No, Scott mentions that only 9 contracts last week, but the Olshan report with one over 10 million. So it's the first time we've seen the luxury market slow, which again, the luxury market
could be seasonality too, potentially.
I'm going to lean on seasonality because, look, it's one data point. But generally speaking, the luxury market kind of is the bellwether for the city. So when that starts slowing, everything else is probably is following in its wake. So let's hope the luxury market pulls it out. Come on, luxury buyers, wake up. Get out there.
All right. Well, and the dollar's down. So, I mean, you'd think some foreigners would put some money to work, but I don't know. It's August.
Yes.
Yeah. Okay, we'll keep an eye on that. One thing with mortgage rates, guys, you look at the Fed funds rate, right? Where's my Fed funds rate? Here's my Fed funds rate. Fed funds rate's at 425 to 450. 425 to 450. That's our base benchmark level. The banks then add about 250 basis points on top of that. Okay, on top of that to get us to 6.8, 6.7, right? That's called the spread. That's called the spread between 30-year mortgage rates. And I guess you can call it 10-year Treasury securities yield, but I was looking at the Fed funds rate. Doesn't matter. Similar type of measure. And what I want to show you guys, normally, the spread is somewhere between 1.6 and 1.8%. That is typical. For 23 and 24, that spread was much higher. For 25, we're still high, but we're coming back down. So you still got like another, half a point just in the spread compression that's above normal for typical. I don't know why. Is it because it's a higher inflation environment, higher risk? I don't know.
It's possible, but you think about what the history of that spread compression is, or your normal range, where that came from, what that baseline is. And if you think about the baseline, maybe was set when rates were essentially flat. I mean, there's only so much you can raise above a flat rate where people will just stop doing business with you. So I don't know how much of that is a historical anomaly, that normal rate, but it's nice the fact that we're coming down. And I still think there's a little bit more room. And we talked about this.
Right. We talked about
a while ago, which is the idea that mortgage rates could come down on their own without the Fed doing anything, simply as that spread gets erased over time. And that's what we're seeing. But
yeah,
it's stubborn. It's a stubborn spread. And honestly, I get it. You look out there, there's just a lot of uncertainty to be loaning money for 3 years or 30 years at a fixed rate. So you gotta make up for that somehow.
Yeah, and that's the main point I'm showing this to you guys is that mortgage rates could still fall about a little more than a half a point, even without Fed intervention or the market's doing it. There's some room there, so that's a good thing potentially, I guess, for us. We'll see. Okay.
This is where you get, the mortgage bankers will often have incentives if you have a client at the bank or you put X amount of money in the account.
Right.
That's where they get that. That's that padding where they can monkey around with the rates.
Oh, I like this question from Robin. This is a John question. Does the secondary market affect the spread? I don't know.
Possibly. I don't know the answer to that.
Above my pay grade, Robin. I just do not know the answer to that question. Anyone here know?
You can look at residential mortgage-backed security ETFs and some of the trading things there, but a lot of those they're less focused on rates and they're more focused on how many people are paying things back. Like they're more interested in like, what's that rate? Because that sort of eats away at the premiums they're charging. So yeah, it's a great question though. We should have a mortgage specialist on.
We will
to talk about that.
Yeah. Ace. Remember Ace? He's good.
Yeah.
We'll bring Ace on. Yeah, I think he knows about that kind of stuff. He's a good guy to answer that question. Guys, in case you're wondering where the central bank of the United States is right now relative to other developed countries, this is what it looks like. We're kind of at the top. We're kind of at the top. So there's this idea that the Fed's got some room to come down, and the jobs number is opening that door right now. So now the question is, over the next 30 days, does inflation come back? Do the tariffs start to impact in the numbers? Does the jobs report change and go back up? Does anything disrupt the fact that the Fed looks like they're going to cut a couple of times? But looks like they got some room to do it, John.
No, I mean, first of all, I like this chart. It has like this postmodern needlepoint to me, just sort of like kind of funky, kind of thing you might see on a t-shirt downtown. But yeah, you're right. Look, the U.S. is up there. 4.5%, 4.38%. Look at Switzerland down there. It's really low. Here's the thing, though. Our people are buying our debt because we have a high rate. If that rate comes down and the debt is no longer as attractive, well, what happens? It becomes far more expensive. So careful.
Interesting point
there.
These are not treasury rates, Robin. No, these are their central bank rates. This is their Fed. We are at here 425 to 450. So this is their version of their central bank. Okay, they're rate setters. Central banks are setting the benchmark level. I would say, guys, this is well in the weeds, very macro kind of a thing. But this Japan rate down here, there's a theory going on out there that this whole rally we're all experiencing goes as long as the Japanese yen carry trade is alive and well, and that when that changes, this whole thing collapses. And Japan's rates have been going up lately, like higher. So nobody, obviously, why does a New York City real estate agent want to worry about the Japanese rates? Again, it's Macro Monday. This is something that some of us on the inside are kind of watching to see if it's going to trigger any kind of a credit spread widening, risk off period, which then trickles down to our market later on down the chain, right? It all starts up here and then it goes down.
Just to explain what that is. So the idea of a carry trade is you borrow a metric ton of money from Japan at a very low rate, then you lend it out in the US or Norway at these higher rates. And what happens is you borrowed a ton of money and then you've lent it out, but typically you're lending it out for periods of time because then you're just making that rate arbitrage. However, if push comes to shove and that Japanese rate starts inching up and maybe the US rate starts inching down and you're squeezed, but you can't get out of it, right? Because you've loaned it. It's not necessarily callable. You can't just bring that money back. So then it's like, that's when you see the credit spreads start rising because people are starting to sell what they can when they can in order to get that money to pay back. So
yeah, deleverage.
That's when things start getting ugly. It's a deleveraging thing, to your point, Noah. And look, it's a long ways away, but it's one of these things people talk about. So it's helpful to have in the back of your brain.
The last time we had a real deleveraging was the great financial crisis, guys.
Yeah,
that was the last time we had a real deleveraging. The whole regional banking crisis in 23. The pandemic, I guess, I don't even think the pandemic was that much of a deleveraging because the playbook from the great financial crisis that the Fed developed was quickly applied to the pandemic. And they basically said, we're just going to create inflation to get out of this. 5 years later, here we are.
Yeah. There's a little one, taper tantrum 2016, but not to the extent.
Yeah. Okay. So that's that, guys. Let's shift to housing really quick. I got a couple of housing charts, and then we're going to circle back to Manhattan. We're going to end this whole thing up. I guess where's my time? I got 3 minutes, so let's try to do this pretty quickly. Guys, we've shown this chart before. The point is that, when you look outside of our little market here, to have a general understanding of what's going on in housing across the country, this is looking at the change in inventory over a long period. This is pre-pandemic to today. Okay, so they're looking at pre-pandemic to today. The brown is negative 50%, meaning inventory is down 50% from July 2019 pre-pandemic. The blue-green, whatever that is, green, that's up 50%. And I mean, I can't help but look at, this Northeast region and just ancillary to the north side of this Northeast region versus everything else that's going on. So this is a very disparate housing market. And guys, whether you know it or not, there are housing markets rolling over right now that are down notably, mainly in the South, that we're just not seeing. So whatever shape and form this housing recession takes, okay, in early stages, it's going to look very different for the Northeast than the rest of the country.
Yeah, and this is why I like to read articles about housing. Obviously, I like to dip my toe into the waters of macro national housing, but it's just it's not something you can use when you're actually out there buying and selling homes. It's good for just sort of a national background, but
yeah,
what's happening in Texas is completely different than what's happening in Vermont, which is completely different than what's happening on the Upper East Side for two-bedroom, Yorkville co-ops, which are amazing.
That's right. And Redfin puts out this thing every once in a while. I like to update you. They have, when they do a measurement of buyers and sellers and whether or not there's leverage on one side or another, typically these lines are supposed to be somewhat together and somewhat track each other's trend. You could see the difference in buyers versus home sellers. Buyers are that light color, sellers are the blue for 20 and 21, 22, right? The pandemic era. But it's flipped. It's flipped. And again, I don't think you're seeing this in Manhattan. Like Manhattan sales is weak. It's weak, but I wouldn't say we're like quickly declining like Texas or Florida in terms of price. So
true. I think what's helping our market is the lack of growth in inventory. And this is one of the things that's been a consistent theme on our weekly updates for the last however many years, which is the idea that there's supply is just doing its thing. It's just like every week is the same as the year before, the same as the year before that. It's just inching up, inching down with seasonal patterns, and it's not starting to get ahead of itself. So even though we did see a little bit of a year-over-year build last week, again, that's one data point, we're heading into a slow period. Those dynamics have been mainly kept in check. Now, obviously, you dig under the surface, you can see that, again, the luxury versus the non-luxury divide is real, but there's not a blowout in inventory, right? We're not seeing that seller line really accelerate. So,
Right.
I mean, look, maybe there's an iceberg of private listings out there, which I hope not, but so far so good.
Yeah. Keep an eye on this, guys. I feel like this is mature in its cycle. I feel like at some point this is going to go the other way, but you know, we'll keep an eye on it. It hasn't happened yet. Finally, guys, this is one of my last charts I got here on outside of our Manhattan little bubble that we're in. I thought this was really, really interesting. You think about office space, right? Office space, U.S. office construction spending. That's that green line on top, guys. We are in an office market, right? I think our office market's just starting to really come back right now. It's starting to get some steam. I don't know how much spending is going on. I think this is probably more representative outside of our markets, but there is a clear trend when it comes to outside investment. They're not investing in office. They're not investing in office. They're investing in data centers. I mean, John, you mentioned that you had a chance to potentially invest in a data center like 10, 15 years ago.
I did. Yeah.
I mean, that would have been an insane call, by the way. But look at this. Like this, I could see this trend. I could see this crossing, and I could see this continuing for another decade.
Yeah, look, it's an AI play, right? And we're seeing the same things play out with the so-called Magnificent Seven and the S&P, which is the stocks that, you know, Meta, Google, you know, Salesforce, anybody that's got powerful AI presence is just on fire. If you're a small to mid-cap stock, which are 95 to 99% of American businesses, you're not doing as great as the AI people. So that's, I think, what we're looking at here, right? So think about it this way. You have classic brick and mortar office space businesses, kind of slumping, AI on fire. Now, I don't know if there's a $1 billion pay package for, you know, a couple guys who are smart in real estate and are familiar with AI, but hey, I'll raise my hand for that.
Yeah. The level of CapEx spending that some of these big companies are putting towards data centers is insane. It is insane.
It's a high capitalization kind of thing. It takes a lot of capital to build a data center.
Yeah, I know. It reminds me of the whole fiber optic play in 2000. I don't know why. It just does. You know, that whole thing. We'll see how it all plays out, guys. Well, we did it. We've reached the end of the program. We got one more slide to show you guys. We don't want to leave you hanging. We'd like to go back.
Question. Deborah asks, are people not selling because of capital gains tax? And this, I think, is referring back to the national chart.
I think they're not selling because, well, first off, it's different if you're a seller in Florida than in New York, by the way. But I think they're not selling because they have a rate that's just still lower than what's out there right now. They have nowhere to go to, is probably a big thing in the Northeast, is probably why they're not selling. And there's no real reason. They still have a job. Like, there hasn't been a major jobs recession yet. I mean, we got a bad print, but a bad print is not a trend. The unemployment rate's still like 4 point something, so it's low. Yeah. So until all these things start to change, you're going to have supply restricted, at least in certain areas like the Northeast.
Yeah. And Hillary writes in and says, data centers are so controversial over the water and energy they use, which is affecting the surrounding communities. Yeah, you're absolutely right. This is one of the reasons why there's an idea, I think, to put some of these in space. So you launch a nuclear reactor up there, it generates all the electricity you need. No one's worried about it because, hey, it's just in space. So nutty idea to solve this problem. What could go wrong?
We can't even build them here.
Well, you know, technically the sun is sort of a nuclear reaction, but again, this isn't macro physics.
No, it is. Yeah. Okay. The sun is definitely an energy provider. I would agree with that. All right, let's go out of that area and move into this area. Let's go into an area we know a little bit about right over here before we start building nuclear power plants in space. I want to show you guys the UrbanDigs market index. This is the UrbanDigs proprietary Case-Shiller, so to speak. We literally mimicked the methodology behind the Case-Shiller and the Dubai Home Index, those two public indexes. We did that for Manhattan. It is a regression analysis. And take a look at where we are, guys. I'm drawing a line basically of where we are here. According to my index, now we don't have this on the site. On the site, you go to resale condo price per square foot. But according to where we are right here, we're still, down from 14, 15, 16, 17, even early 18. It's like if you bought a property in 19 and early 20, that's the only people that are actually profitable right now, positive in terms of our index. So I wanted to show you this just to have a general mental map, guys, of where our price action is. I mean, we did a whole bunch of nothing for like the last 11 years.
Yeah. And, so we also have the service called Advisor, in which we help people do pricing analysis, and whether it's for a new listing, market adjustment, et cetera. And one of the things that's really striking is how many agents have clients who bought 2018, 2019, or worse, 2015, 2016, and they paid a pretty penny, and they had to overbid to get it, and now they're looking to sell 10 years later.
More of
like,
those.
What?
Yeah.
Wait a second. I'm not breaking even. How is that possible? So again, look, all price points, all property types are different, but there are certainly some tough conversations happening out there right now.
Yeah. Yeah. Especially if you bought in 14, 15, and 16, there's some really tough conversations. Sometimes the market's penalizing you a lot more than what this chart suggests. I mean, you look at this, so it looks like we're down 1 or 2%, but I see some people taking 10, 15% cuts, losses on these. So guys, just make a mental note of this. This is what I got. I want to give you as much data as possible. We've come to the end of the program, guys. I assume there's no more questions. Okay, there is. Stick it up there now. Otherwise, we're going to cut off very, very shortly. Go ahead, John.
Well, I was going to say, so we're 6 minutes over. That means it's free today.
It's always free. Thank you, John Walkup, for always spending some time over here on Macro Monday. We all appreciate it. And you got the best name in real estate. All right, don't deny it. I am Noah Rosenblatt, guys. We are both with UrbanDigs. This has been Macro Monday. Hopefully we'll see you next time. Go enjoy the day. Cheers, everyone.